All right, everybody. Well, welcome back to another module. This module, we're going to be covering investing. And so hopefully for many of you, it might be a little bit more exciting than budgeting or insurance. So let's go ahead and get started. Okay. So one of the things that we need to make sure that we're doing is we know where we're trying to get to from a financial perspective, right? What are our goals? What are our circumstances? So before we start investing, we need to make sure that we're looking at where do we currently stand? And some questions that you might be thinking about is, okay, what goals do I have, right? So many of us might be saving for a down payment on a house or maybe a new car. You might even be thinking, I'm still in college, but I know that at some point I want to stop working. So retirement might be something that you're wanting to do. But you may be thinking, well, I also need to pay down my debt. I want to make sure I have some money set aside for an emergency. And so we want to make sure we're thinking about all of these aspects before we start jumping into investing. And the reason is because we don't want to have a bunch of high interest credit card debt and put money toward investing, because if we think about paying off credit card debt, that is comparable as a return than so not paying a 22% interest on a credit card debt versus receiving a 10% or a 12% return on your investment. It doesn't make sense to do that. So again, before we get started, before we want to start investing, we want to make sure we've looked at where we're trying to get and what our current financial circumstances are. Yes, compounding works in our favor. We want to be able to invest as long as possible, but it doesn't make financial sense to be earning a 12% return in the investments that you're making, yet paying, 18 to 20% in credit card debt, or earning 7% in a mutual fund versus paying, 8% on your student loans. Okay. So or not having enough money in an emergency fund. Because if you invest, right, investments are typically a longer term investment, and your car breaks down and you have to sell those investments to pay for the car, it just doesn't make a whole lot of sense. So again, we want to make sure we know where we're going and what our current financial situation is like. Okay, so savings versus a return on investment. When we are thinking about um, returns, we want to make sure that we understand that a percentage is going to be different than a dollar amount. Okay. So as you can see here, the difference between an 8% and a 10% return on $2,000 is only about $40. All right. However, the difference between that same 2% on 2 million is 40,000. Okay. So we want to make sure that we understand that there is a return, and that return is going to be dependent on and different from the actual dollar amount that we're going to receive, right? So receiving a 100% return on investment might be great to talk about, but if you only have $100 and your $100 turned into $200, not super well. But if your $50,000 turned into $100,000, might be drastically different. Okay, so here's just a couple of things to consider as you move through this idea of investing. So one, we always want to think about our budget and where money is going to be going into different categories. We want to try to put savings at the very top. Okay, so the best of our ability, we want to move that money out from before we spend money. Okay, so we want to pay ourselves first, right? So number one. All right, we want to work to see if we can make things automatic, right? And what I mean by that is typically we can use a 401k plan, or you can set up an automatic investment strategy. If you have an account, let's say at Charles Schwab or Fidelity, you would like to set up where these payments are moving into that account and then automatically invested. You don't want money sitting in your investment account just in cash, because then it's not doing what it's intended to do, which is to invest and generate a return based on that the different investments that you have. Okay, so number two, we want to make sure that we are working to make things automatic. Okay, three, we want to make sure that we are trying to capitalize on any additional dollars that we can get our hands on. So if your employer offers a match, I would strongly encourage you. And again, going back to the first slide, right? If you have a lot of debt, ideally, it's probably not a good time to start investing. However, if you're employed and your employer offers you a match for retirement, I would encourage you to put at least the minimum amount to get the match. So if they match, let's say the first 3% of what you put in, and your cap is 5%, I would put in, the 5% so that you get the max 3% match. Um, Obviously, you need to make sure that you're looking at your financial situation and you're able to make that contribution. But if you can do that, you're not leaving any money on the table, right? And that's where I think it's very important. If you put in 5% and your employer puts in 3%, now you're up to 8%. And over the long term, that can be extremely valuable. Okay. All right. The next is you want to probably discuss the different types of tax advantages that investment accounts can offer. I think it's very important, especially for young students, to realize that when you are looking at an IRA, for example, an individual retirement account, that is not an investment. That is an account type. Okay. You can then place investments or purchase investments within that account type, but it is going to be, in this case, all of those monies are going to be, if it's in a traditional IRA, is going to be tax deferred, meaning you don't pay tax on that amount until you take it out. Of course, the Roth account is separate, is different. You actually will pay tax on the contributions, but you don't pay any tax on the distributions. And then you also have, obviously that's reducing your taxable income. Okay, so if you made $5,000 this summer and you put in $3,000 into an IRA, well, now your income is only going to be $2,000. You're only going to pay tax on that $2,000. Okay, so we want to just be thinking about the tax advantages related to retirement planning. And then 5, we want to be thinking about how do we allocate toward our budget and our process if we were to get an inheritance, any other type of windfall, if we get pay raises. And there's traditional advice that would say, look, keep your lifestyle the same if you get a raise, and put any raise amounts into your future retirement account, or maybe just put that raise into a savings account, but keep your lifestyle the same. What a lot of people do is if they get a 5% bump, they will actually say, oh, I'm making an extra $5,000 a year. Now let's spend that extra $5,000 a year. And instead of doing that, ideally, we want to put that $5,000 into a savings platform and keep everything the same. Okay, just some thoughts. Okay, so I get a lot of this question when it relates to investing is nothing more than gambling or speculating. And there are a lot of characteristics in those two things, in that you don't know the future. And that's probably the main difference between investing and speculating. So I've given you some definitions here. An investment generates a return typically in two forms. It provides an income and it provides price appreciation. Now, that price appreciation does come from a supply and demand function, meaning that if you buy into a company or any type of investment and there is a more demand than there is supply, and supply typically remains fairly constant, okay, unless the company is constantly issuing new shares. If the demand goes up for that because the prospects of the future look really good, that is going to raise the price, and therefore you have the ability to sell your investment at a higher price than what you bought it. Speculation, however, is merely a supply and demand function. Okay, so it is only a supply and demand. And in some cases, you might even look at gambling. Gambling is really a matter of choice. Investing is a matter of strategic information used to make a decision. Investments, you don't just randomly throw money into an investment. You strategically think about, what are the prospects of this investment? Is it going to yield a return? What's my expected return? Is that expected return going to always be met? No. But it is not necessarily a gamble, meaning you could win or you could lose. Okay, so just there's a lot of obviously difference there. But in speculation, it really is only if someone is willing to buy that at a higher price. All right, there is no Um, um, Typically, there is no income being generated through speculative type of investments. Okay. Now, crypto is changing, right? So crypto is unfortunately it's not an asset that has any backing. And what I mean by that is like the federal government has backing by its power to tax. That is its ability to make its payments. Companies are backed typically by the revenue that it makes for its products or services. Crypto is a non-tangible product that does not have any backing. It is merely rising in price or falling in price based on supply and demand. If there's a lot of people that want it, the price will go up. If a lot of people don't want it anymore, the price will come back down. And it's been classified as a uh, to store value, uh, but I'm not sure I see that. And the reason I don't is because it changes in value so much and pretty drastically. And you don't want to put something in a savings account where one day you look at it and you're up. Let's say you have a $5,000 savings account and it goes up to $7,000, and then it goes back down to $2,000, and then it goes up to $5,000. That's not an intention of a savings account. So a store of value is challenging. It can be used obviously to make trades or to buy things, but even that is still yet in its infancy, right? There's still growing um, value in terms of how to be able to pay for things. So we're still out on crypto, whether or not it's an asset or if it's a store of value or if it's merely a speculation type of asset. All right. Hold on. I got to get back to my next slide here. Okay. All right. So where can we decide to invest? Right. So there's a couple of different things that we can think about. We can think about ourselves as a lender, meaning we have excess money to lend. Okay. And we can do that through our savings accounts or our bonds. Okay. These are both lending investments. What I mean by that is I give the money to my bank through my savings account. The bank now can use that money to go and make other investments, right? Through loans. They're going to pay me an interest for using my excess money. The same thing is with a bond. If I give a corporation my, let's say, $1,000 to buy one bond, they're going to use that to generate, they're going to buy equipment maybe. And that equipment is going to be used to generate a revenue or some sort of money, or revenue. And then ultimately it comes down to a profit. I receive my return because the lender, the borrower is going to pay me interest as they use my money, and then eventually I get my money back. Ownership, however, this is different. This is referred to as equity. And equity can come in the form of preferred or common shares. It can be private ownership. There's a lot of different ways that ownership and equity can basically become synonymous. But here we're buying an asset. So here we buy an asset. Okay. When we're lending, we aren't buying anything. We are providing our money, our capital to someone else to use, and then they're going to pay us for using it, right? It's kind of like a rental, right? They're going to borrow our money, they're going to use it, but they're going to pay us a rental fee, and then eventually they'll give it back. But when we buy something in terms of equity and common stocks, we are buying ownership interest. And that's important because it helps our mindset understand what types of products are we comfortable with when it comes to our investment choices. Okay, we're going to see actually as we go through the rest of this lecture, there's going to see two main components, and one of them significantly that flows through all investments is this idea of inflation. Inflation is it's a very real reduction of your returns. Okay, so a nominal return is basically a return where we have the real return plus an inflation component. Okay, nominal returns are what we see in the world. These are what we see. Okay, when you go to the bank, and you say, hey, what is the current rate on a CD? They're going to say, well, it's 3%. That is a nominal rate, meaning that rate is going to compensate you as a real return, plus it has a feature in it to compensate you for inflation. All right. Now, and that's important because when you are comparing various investments from different industries, from different worlds, not worlds, countries within the world, we want to make sure we're comparing on a real rate. Okay. So, again, very important. So let's just take a look at this example here in the middle of the slide. If you earn 8% on an investment and inflation is 3%, then your normal return would be 8%, and your real return is going to be roughly 5%. Okay. Now, we don't need to get into the math, but it's going to be a rough estimate. It's not going to be exact. So our nominal, again, nominal is real return plus inflation. And so our real return is going to be our nominal return minus inflation. And this is an approximate. Okay. So don't worry about it, but you can get an approximation of what your real return would be. Okay. Okay, so in the PDF that should be uploaded, you should see this link. You can go through it. It kind of gives a broad overview in terms of investment fundamentals. So I would just encourage you to take a look at that. All right, risk and return. Hopefully it's a very simple concept, but I will tell you this from a practitioner standpoint, we have a tendency to overestimate our risk in good times, and we get extremely scared of our risk in bad times, right? When markets are coming down. All right, so here's the general rule. As risk goes up, we expect our return to go up. They are positively correlated, right? If we are going to take more risk, we expect more return. The more risk you assume, the greater potential reward you expect. Okay. And our job as financial planners is to help people understand how do we balance these two concepts, a risk and a return. Okay. So higher returns would yield higher risk, right? We would make sense of that, right? So what are some various examples? So stocks are more risky than bonds. Small companies are riskier than larger companies. Okay. Emerging smaller countries are more riskier than developed market companies, right? So, like the companies within the US are probably less risky than a emerging country, right? So let's think about Turkey, for example, or Ukraine, or some country in South America, right? Not necessarily Brazil, but maybe a small country. Those countries are going to have more risk because they're not developed yet. They may not have a developed infrastructure for market trading. They may not have the cash flows. The company economics may not be there. So there's a lot of things that might be able to prove that emerging companies are less likely to generate returns, and therefore they're going to be more risky. All right. So we have stocks, typically riskier than bonds. Company size, so we have larger companies that are less risk, or smaller companies that are more risky. And then we have global markets. So we have developed countries are less risky, and developing or emerging countries are more risky. All right. So again, there is a significant relationship between risk and return. Now, the challenge is that when you start to combine assets, you can actually begin to reduce the combined risk with adding risky assets. So let me just give you an example. If we have an asset here, asset A, and it is, we'll call it a high risk, and we have asset B, which is a low risk. When we combine these two, okay, we can actually reduce the risk from A alone, which means our blended portfolio actually will have a lower risk than owning A alone, right? So we want to begin to diversify our portfolio, okay? Here's another video that can be watched regarding kind of this risk and return relationship. Okay, so again, it's in the PDF. You should be able to click on that to watch that. All right, so how do we look at returns? How do we look at risk? How do we do this? Okay, well, we can look at several historical ways or historical measures of return from an investment. But that's not ideal. We typically want to look at the expected return. And again, we don't need to know this. We use a formula called CAPM. Okay, it's just a formula to provide an expected return. Okay, and we can use standard deviation, which is a measure of variability over time. Okay, so if you have a stock that does something like this, you might look and say, wow, that moves up a lot, and there's a significant variability in its returns as it moves through time. So as we move through time, and this would be our expected return or our return, okay? That would be very, very, very significant in terms of its variability versus something that looks like this, okay? This is much lower risk. And why is that? Well, because the change in its price is very, very, very small. Okay. Whereas here we have significant changes in price, okay, or returns. All right. So this is going to be much more risky. Okay. So when we're investing in the stock market, there are basically two broad sources of risk. There is systematic risk and there is unsystematic risk. Generally speaking, unsystematic risk is kind of referred to as business risk. In other words, the risk that's associated with owning companies and their business structure. Systematic risk is the risk associated with being in the market as a whole. It is the risk being involved in the system. Okay, this is going to be non-diversifiable, meaning we can't reduce systematic risk. Systematic risk is what it means to be in the stock market, period. If you are in the stock market, you have systematic risk. You cannot diversify enough. If the stock market as a whole drops, it doesn't matter what positions you're in, generally speaking, you're going to experience a loss of value. However, if you own just Microsoft or just Apple or just Nvidia or pick a company or even one or two companies, you will find that your return or your risk can be much higher because there are unique risks to those specific companies. That is what is referred to as unsystematic or diversifiable risk. You should be able to eliminate diversifiable risk by diversifying. So you can reduce the risk exposure that you have by owning just one or two companies by owning the entire stock market as a whole. Okay. And therefore, you are not going to be given a expected return on non-diversifiable risks. Okay. So remember, this risk is about the risk specific to holding individual companies or industries, and you have reduced your diversification. Okay. So you have a lot of business risk. If you own Microsoft only and Microsoft has a really bad quarter, your account might go down quite a bit because investors may sell off Microsoft stock, which would cause your stock to drop. Okay. Okay. So we have the diversifiable risk, okay, which is the unsystematic risk, and then we have the non-diversifiable risk, the systematic risk. Now we have interest rate risk and inflation. Okay, so interest rate risk is probably a conversation that you've had maybe in the last few weeks or even months as interest rates from the Fed have been rising. As interest rates rise, we see several main things. Our equity is going to be impacted because companies' costs of borrowing are going to be higher. As they as their borrowing costs are higher, they may not be engaging in product development or new products, and therefore their returns and their futures might look less exciting. However, we also see that as I just iterated, the borrowing costs for our money is also increasing as interest rates change. Remember, interest rates is what we are charged for money. So if a company or even if you, if your credit card starts to rise, if your credit card interest rate starts to rise, you may be less likely to spend money on that credit card because you know it's going to cost you more, assuming you're not paying it off. All right. So interest changes can drastically affect both equities and fixed income, although it does have a bigger change on fixed income investments. There's also inflation. Again, as we've talked about previously, when we looked at nominal and real rates, inflation reduces the purchasing power of your money. Meaning, as we move in every day and inflation remains high, the cost or the ability of your dollar to buy the same amount of product is going to be decreased, right? You will not be able to buy the same amount of product with the same dollars today. In 2 weeks or even in 2 months or 2 years, let's say you start tracking, let's say you really love Captain Crunch cereal. And you go to the store today and you say, okay, it's $4.99 for a family pack. And maybe you even put on there what the per ounce cost is. Go look at it in 6 months and see if it remains the same. Look at it in a year and see if it remains the same. Now, you're going to see that maybe the price stays, but maybe the packaging volume goes down, or maybe the packaging volume stays the same and the price goes up. Your dollars are buying less product. Okay. If prices go up and volume stays the same, or if volume goes down and price stays the same, you're still buying less product for the same amount of money. Okay. So inflation is a real risk. Now, again, we also have business risk and financial risk to us consider. The business risk is what is referred to as the management decisions. What is management doing to increase their likelihood of producing more revenue? Okay. Can they introduce new products? Can they reduce their costs? Can they reduce their price and still have volume increases that offset price reduction? These are all things that can impact an investor's return. There is also the financial risk, and this really comes down to what's referred to as leverage, or also referred to as debt. Okay. So these are the decisions that businesses can make as it relates to its financial obligations and specifically related to debt. For a company that doesn't have any debt on its balance sheet, it is actually going to have no or very low financial risk, right? It doesn't have to make those financial payments, and therefore it can use money or doesn't have to make as much money to still be a viable company. Okay. So financial risk is about the financial decisions the company makes. The business risk is about its management decisions. Okay. What types of products? We might also think this is price times quantity, which is our things that impact our revenue. All right. Another type of risk would be liquidity and market risk. Okay. Liquidity is the ability to be able to sell a product or an asset quickly at fair market value. So security quickly at a fair market price. You could sell anything, right? You could put something on eBay that's worth $100 and sell it for $2, and you'd probably sell it very fast. That doesn't make it liquid. You want to be able to sell a $100 product for very close to $100. That would make it a liquid investment. Can you think of something that would be a liquid type of investment? Your checking account. If your balance is $100 and you go into the bank and say, I'd like $100, they will give you $100. If in 2 weeks you have $100, you can probably get $100 out of your account. Okay. So that's a very liquid. As we also talked about previously, is that there is a market risk, right? This is the risk that the market as a whole, which is impacted by the business cycle, which is impacted by global events. Obviously, as we go through various world wars, all of those things can impact the market as a whole. Okay. So we want to make sure that we understand that when we're investing, we have inflation risk, interest rate risk, liquidity risk, market risk, business risk, financial risk of the companies that we own. These are all risks that we need to be aware of when it comes to our investing choices. And this is why it's so important to be talking to a financial professional when you get to the point of really saying to yourself, look, I feel like I'm in a position to start making investment choices. I need to probably reach out to someone who can help me make these choices. Okay. Another set of risks, obviously, are going to be exchange rate risks. We live in a global economy, but unfortunately, we have a lot of different currencies. And those currencies can fluctuate in value in relation to each other. And typically, it's based on, again, supply and demand of products, imports, and exports that countries have as it relates to their trade balance. We also have political and regulatory risk. Our government in the US could pass a law that requires, I'll give you an example, right? Just recently, there's been speculation that there may be a tax on unrealized gains. That is a significant risk for investors because if they have a significant gain that's not been realized, meaning they haven't sold this asset yet, they may be taxed on that. Well, if they're taxed on that, they have to come up with that tax from somewhere. That can create a significant burden on individuals, meaning that there's less likely to spend money, and therefore the value of companies might start to decline because people are spending less money. So those are the types of political and regulatory risks that investors need to pay attention to. So how can we help eliminate or at least reduce a lot of these types of risks? Well, diversification really is the way to go. And diversification is just this idea that you have a small amount of investments in a lot of different assets or asset classes. Okay, we are reducing the risk by spreading out our investments among different investment choices. Okay, now what that does is it allows some bad things to be offset by good things, right? So generally speaking, the investments we want them to generally move up and up in a positive way, but it's not going to move up as fast. And the reason it's not going to move up as fast is because we have canceling out, or we have some investments that will not perform as well, and others that will perform really well. And of course, we're going to reduce our risk exposure. And what happens when you reduce risk? You also reduce your return. Now, it's important to know that diversification can be at the industry level. You can look at different industries. You can diversify into sectors. You can diversify into asset classes. You can diversify into countries. Okay. So there's a lot of ways that you can begin to slowly diversify your portfolio, right? You can move from one company to several companies, to different industries with different companies, to different countries. Obviously, asset classes, we could look at their stocks versus their fixed income. You could buy real assets, you could buy timber, you could buy commodities. There's a lot of different ways to diversify your portfolio. Now, diversification, again, helps with this idea of unsystematic risk. This is where diversification is powerful. Systematic does not go away. However, remember I talked about systematic risk being the entire market? Well, if you are in the US market, the US market may actually act differently than the Nikkei, which is the Japanese stock market. And so if you want to diversify against markets in terms of the system, you can actually invest in the US, you can invest in Japan, you can invest in Brazil or in Europe. You can invest in different markets. Not all markets are exactly correlated. So you can begin to slowly diversify. But remember, diversification is I've got a small amount of money here, I have a small amount of money here, etc. Okay. As you begin to add this various investments to a portfolio, you are beginning to reduce its risk, and obviously through increasing its diversification. We find that typically 30 stocks has kind of always been the number that one would say you probably have a pretty diversified portfolio if they are in different sectors slash industries. In other words, you can't own Apple, Microsoft, Nvidia, IBM, and be like, I'm diversified. Well, you are diversifying a little bit, but you are now heavily concentrated in what? Tech, right? So what happens if the tech sector starts to fall? All of those companies are going to start to fall. So we want to make sure that we're not just buying stocks to buy stocks, but we're strategic in the types of stocks that we're buying. Okay. The time dimension of investing in risk. As the length of the investment horizon increases, you can afford to invest in riskier assets, right? So if you have this long time horizon, you have the ability to withstand some of these significant drops, right? You have the ability to withstand that because you have a long period of time. If, however, your time period is, let's say this is 1 year, and let's say this is 30 years. Okay. In 1 year, you don't really have the option, or you may not have the option to experience this drastic reduction in value. So the sooner your time period is, your time horizon, the shorter this is, so a short time horizon, you should have a more conservative portfolio. And the time horizon is to when the money is needed. And obviously, a longer time horizon, you can become more aggressive, typically in nature. Okay. I'm not saying that you have to be, but it typically allows you to become more aggressive. All right. So when you think about the fact that we have a goal, right? And we've talked about that at the very beginning of this lecture. We have a goal, and we have the time to when that goal is needed. We need to be able to choose different assets that are going to fall in line with that. So that's where a financial advice can really become helpful. Here's just a slide that just talks about, as you look at history, time periods actually change based on the number of time that you have within your period that you're looking at. Typically, in the stock market as a whole has increased upward, and those are traditionally, long-term average of between 8 and 10%. Obviously, if you look at a shorter time period, that may not always hold true. Okay, so understanding your tolerance for risk, we want to make sure that we are talking to a financial professional. Okay, this is where they can help you with a questionnaire. They can also talk to you about asset allocation and how those different assets can come together to build a portfolio that is going to help you feel comfortable, yet still reach your financial goals. So we want to make sure that we're doing this inside of a plan, right? So we want to make sure we understand what our goals are. We want to know what our investment options are and how that risk that we have, that risk tolerance, is going to help us decide what type of investments we should invest in. Again, we can look at money market securities. These are going to be things that are typically very liquid, that are coming due for maturity. We can do stocks, which is common stocks and preferred. We can also look at fixed income. We can invest in IPOs. That's this primary stock market. We can also buy through exchanges. Okay, this is where we are buying shares from other people. And here we have IPOs. The initial public offering is the primary stock market, and the secondary stock market is going to be whenever we see the investments coming up. Just a couple of comments here. So a couple of different types of investors. So you would be an individual investor, you as the student. We're going to have institutional investors. These are going to be companies, corporations that are investing their money on behalf of their goals and objectives. Portfolio managers, these are people who are managing money for a specific basket of investors. These are going to be professional money managers. And then, of course, we have day traders. Day traders might be people that are buying and selling stocks or bonds or any investments very quickly, right? They typically will buy something within a few minutes. might hold something for a day or two, but they're constantly trading and they're providing liquidity to capital markets. Now, we talked a little bit about stocks, we talked a little bit about bonds, but there's also the opportunity to buy investments that are um, baskets of securities, right? So we can look at these in terms of, they're called mutual funds. Mutual funds are where people come together, they pile or pool their money, and then the portfolio manager that's been hired will go out and select the individual investments for that specific set of pooled money. Okay. And it's typically designed to have a specific purpose, right? Whether it's we want technology growth or we want to invest in companies that pay dividends, there is typically a very specific purpose behind how that money is going to be invested. You can invest in exchanges. I'm sorry. There are indexes that are used typically to track a set of investment parameters. So you don't invest in an index in and of itself, but you would actually have someone create a investable pool that is tracking that index. And we typically use that as a performance benchmark. We can also invest in real estate, and we can do that through obviously buying our home, although I wouldn't classify that as an investment. But you could buy into real estate through REITs, which are referring to as real estate investment trusts. This is where you would pool money and someone goes out and buys real estate property, and then the rents that those rental properties generate are then passed on to the investors. Okay, so return. As we mentioned, how do we differentiate between speculative investments and investments? Sources of return. So typically, when we're investing, there is going to be some two forms of return. There's going to be dividends or interest, and some price appreciation. Okay. Growth stocks typically do not pay out in dividends. The money that's earned from the profits are then reinvested back into the company. And we refer to those typically as growth stocks. Income stocks are companies that are more mature, and they are then going to pay out a form of dividends to their investors. All right, so on bonds, you're going to receive coupon payments and or appreciation. Mutual funds typically will generate capital gains, and then of course they may increase in value because of the underlying investments that are within that basket of securities that the professional money manager is managing. And of course, real estate will have rental income and price appreciation. Now we need to kind of finalize this investment conversation regarding taxes. All of our investments are going to be taxed in some capacity, whether that's dividends, interest, or capital appreciation. All of those are going to be different based on what type of return it is, right? So interest will be taxed at ordinary income. Capital gains are typically going to be taxed either as long-term or short-term, and those are going to have different tax rates. So we'll just want to make sure that when you're dealing with a financial professional, that they help you see what your tax implications would be for your different investments. Okay, this chart just kind of shows you different tax impacts of I think it was like $1,000 gain. All right, I know that was a lot, but again, go through the module, read all of the text that's embedded in that module. Listen to this lecture again if you have any questions, and always email me if you have questions regarding investments. All right, we'll see you on the next